Financials in focus and Deepan's views there. Vinay Jaising is joining us now. He's Managing Director, Portfolio Management Services at JM Financial. Vinay, good to have you here. Good afternoon. Thank you for your time. As a portfolio manager, Vinay, I know it's all about bottom-up stock picking, but do you have a broader sort of market view at all that, maybe things are perhaps at the margin getting a little stretched? Or do you think it's all well and fine and the earnings catch-up is pretty good enough to justify these levels and beyond?
Thank you for the question. I think clearly it's time coming for India to shine. We have a view that the market should breach the 16.5 to the 18,500 band, which it has been in the last 2 years. If you look at what's happened this year itself, Nasdaq is up about 24-25%. Japan is up about 20% and India is flat. So there's been a lot of underperformance India has gone through in this year. A lot of the outperformance of last year has been, I would say, removed off. Secondly, what's also interestingly happened is FIIs who were net sellers last year of $18 to $20 billion. And the last, I would say, a month and a half have put in $5.5 to $6 billion, a great positive. We have retail India through SIPs also putting in a lot of money. So that's another big positive. Earnings results, when we got into the results, we thought it's only going to be the banks which would do well. Very interestingly, if I remove the banks and I look at QOQ number, the QOQ numbers for non-banks are up about 30 to 33% in terms of profitability. So earnings momentum has also been ticked. Finally, the currency. We were a little concerned about the currency last year after seeing 70 levels of the rupee moving to 82 levels. The DXY has corrected from 115 to 103, 104 levels currently, but the rupee is still at 82. Looking at where crude is at about 75 levels, looking at where coal is at about $150 levels, we think the bill for Forex for the country is going to go down. We will save about $40 to $50 billion purely for these two commodities. And it's time for even the Indian currency to appreciate compared to the US currency. So all these seem to be telling us, it's a time for India to move out of this band and do a lot more better. Valuations, yes, when we spoke last time, we were closer to the 17,000 levels. Valuations have inched up from 17, 18 times 1 year forward to 20 times. But what's interesting is when you're seeing cuts happen in the rest of the world for earnings, in India, you're going to see earnings move up. And when we go forward 1 year, when we were sitting here, 1 year forward, which is in, let's say, May 24, and we are factoring in fiscal 25 numbers, we're probably at 16, 17 times with an index level of about 1100 for EPS. So you can see, 15% plus upside in our eyes in the next 12 months and a bottom side of about 6 to 7%.
Right. When I was looking at your underweight, and that really interested me because you're underweight on IT, pharma, and new age. Now, IT, I understand we've been getting a lot of opinion from a lot of the market experts here as well, saying that maybe growth headwinds in the global scenario may keep the IT stocks under pressure for a bit before they, get constructive on it. But increasingly, people are getting positive on pharmaceutical as well as new age. New age largely because everyone's focusing on operational performance at the cost of growth, and the valuations are reflecting that as well. Delivery, Nykaa, as well as Zomato, all of them trading anywhere between 3, 4, 5 times 2 year forward sales. And pharma as well, a lot of individual stocks looking a lot better after the correction that we've seen. What's your call for underweight on all pharma and new age in specific, and what would change your thesis here?
Sure. So as far as pharma is concerned, we prefer playing pharma using the specialty chemical segment. Herein, if you're looking at the raw material for pharma, you're looking at fine chemicals, you're looking at API ingredients. We like companies like AMI. We like companies like Tatva Chintan, which is tomorrow's play on the EV story, or companies like Archean, which is, the bromine chain play. Or Gujarat Fluoro, which is the Korean chain play. So, we like companies in the specialty chemical as compared to pharma. Again, part of this emanates from our state on what the dollar rupee would be. If we think that the rupee is going to be at about 80, we might as well avoid the global names as compared to the domestic names. So, that's part of the reason. Moving to your second question for new age. As far as new age is concerned, we are very focused on the fact that interest rates are high. They are going to correct, but interest rates are high. And today, interest costs for highly levered companies which are not making profits, are going to be a little more difficult. So if operations do better, there are much easier ways to play new age. Two ways to play new age, which we think are SBI Cards and Devyani, a QSR chain and a credit card company, both of them using technology to the hilt and profitable. What would change our thesis? We want to see 1-2 quarters of a possibility of higher EBITDA to see where visibility of profits would come up for the new age companies.
Vinay, in the QSR space, why is it that you like Devyani? Because there are a plethora of options now. You're going with KFC, Pizza Hut, and the Costa Coffee owner, Devyani International, but why not the others, like a Jubilant Foodworks, a Westlife, which owns McDonald's, or even a restaurants brand Asia, which owns Burger King? So why have you selected Devyani?
So between the three, there's little to choose on. Devyani, we've seen the management execute and grow very steadily in terms of number of outlets they're opening, both in KFC as well as in Costa Coffee. So we like Devyani because of that. But, put the other way around, Sapphire, very similar story, same brands, much cheaper valuation. We like that as well. Just between the two, we think the management of Devyani is a lot more aggressive. That's why we are betting on it. As a chain, the QSR chain, we think will do a lot more better than the other consumption names.
All right, when I just hold on to that thought, we have Apollo Hospital's numbers which are flashing for our viewers on the screen. And on the top line, it's bang in line with what Ekta's poll threw up. So that's no problem out there. However, the net profit has come in much lower. So I think we'll have to see whether or not there's an operational miss or whether or not there is something below the operational performance. Because for the time being, the stock has taken a sharp downtake. It was trading well in the green. It's come lower, but we'll need further clarity on that front. And I think our ticker team will be putting up that number. There it is. There is a bit of a miss, actually, on the EBITDA front. That's a miss of close to around 7%, I think so, in comparison to what we were working with. 517 crores is what we were working with. It's come in at around 488 crores. So that's an operational miss out there, which explains why that stock has come in lower. And on the margin aspect, it's missed our estimates by close to around 60 basis points. More analysis on that coming up in just a bit, but safe to say that the numbers are a little weaker than expected. Then we had to take stock of, that company that just came out with its set of numbers. But I was reading your note and you're quite impressed with the recent earnings, that we have got as well, the quarterly earnings. So good on that. And you're, expecting India to improve from here on. I wanted to ask you about the defense space. I think you all got in early in some of these companies. Bharat Dynamics, BDL. But suddenly you have this lumpiness of the business that comes in there. And for BDL in particular, the last quarter's numbers are very uninspiring. You continue to remain a positive stance out here. Will you want to, continue to add on at these levels?
Absolutely. So as you rightly said it, BDL's last quarter numbers, even when they gave their provisional numbers, were a tad bit lesser than expected. So, when they gave the provisional numbers, it came largely in line with what expected came when the results came out. But if you look at BDL's future growth, they have a 5 to 6 times forward order book. They are 7 to 8% in terms of export, which is going to increase to 20 to 25% in the next 4 to 5 years. Their margins are 23 to 24%. And the PAT growth, because last year was a little tepid, is an impressive 25%. And the stock's trading 1 year forward at about 18 times. It's all about missiles. Akash is doing pretty well. So we really like that stock and we are buyers of it.
Vinay, I know broadly you're underweight on, I think, technology. Is that right?
That's right.
Yeah. So across the board, we've seen technology names derate, given the global headwinds, the slowdown in growth rates, etc. But amongst them, are there 1 or 2 mid-cap stocks, perhaps, that you think are attractive? Because there has been a big broad brush of downgrades, but there would be a few companies which are now starting to offer are at attractive levels. Is there anything which has caught your attention in mid-cap IT or in IT?
Absolutely. So we are underweight IT because of 2 reasons. One is the 2-year, 10-year interest rate cycle in US still seems to challenge us. That negative number was 0.5 a month ago. Today, minus 75 basis points. The debt ceiling in US will be raised, and there won't be questions about it for 2 years, so it should soften up a bit. But the fact of the matter is there is pain in as far as US economy is concerned. Also, our call on why the rupee is going to head is making us being underweight the IT space. Having said that, there are companies like Persistent in mid-cap, which have, I think, a good earnings growth. They have a good revenue growth trajectory. They're not in the normal cliche IT space. Here is, a product company which is also having some kind of services which are required, which cannot be pushed on the future years. So that's why we like a company like Persistent. It may be costlier than the large caps, but we very strongly believe that the company's earning growth, even in the market like this, is going to be a healthy 20%.
Vinay, very briefly, I just wanted to hear your thoughts on, you own Supreme Industries. It's come back to all-time highs once again. What's the thesis there, briefly?
So one, capacity utilization of 65% waiting to exhale, FCF positive. The company is at about 30 times one-year forward earnings, 25% ROE. It's part of the building material /capex cycle. So if you wanted to play real estate without buying the real estate companies, you either buy the financial NBFCs, or better still, buy companies which will directly get advantage when the buildings are either getting modernized or you're building pipes. So for us, Supreme is exactly one such company. It's never had a bad return on capital employed, very healthy hygiene parameters, and the entire balance sheet of the company. The utilization rate of capacity is very important, because that means that though the ROC is already north of 20%, it's going to inch up a lot more just because you don't need to spend more capex in this business.
All right, Vinay, thank you so much for joining in and giving us your views on the markets, individual stocks, as well as talking about your sector preferences as well. But meanwhile, we were having the conversation